Hi, Andrew here again. In this video, I want to explain and show you why it's worth taking investment risk and accepting short-term uncertainty when you invest in the stock markets, because we get rewarded by having that patience and discipline over the long term. So I want to talk you through this chart, which has been provided by JP Morgan, who provide a guide to the markets every quarter. And it might look a bit intimidating at first, so I'll talk you through it step by step and hopefully get that message across to you. So what it's showing you is varying returns over different time periods for the US stock markets, the US bond markets. And when I talk about bond markets, I'm referring to investing in government and corporate debt, and then a portfolio which is half stock markets and half um, government and corporate bonds. And we're looking at data here from 1950 to 2022, so 72 years worth of data. The green bars here are the US stock markets, so investing in equities and shares. Blue bars are investing in government bond and corporate bonds. And the grey bars is that 50-50 mix between the two. And on the bottom here, on the horizontal axis, we're looking at different time periods. So we're looking at firstly 1 year periods, and then 5 years, so 1950 to 55 and 51 to 56 and so on, all the way out to 20-year periods. So we're looking at 1950 to 1970, 51 to 71 and so on. So what you can see here is in the short term, the range of returns from investing in the global stock markets is very wide. In investing parlance, it's what we call volatility, in measured by standard deviation. If you remember back to your school days, that's how much returns vary. And we felt this level of volatility and uncertainty recently, in a very recent past, in 2022, with the energy crisis and rising inflation. Stock markets and the bond markets had a very big wobble and fell significantly. We also felt it at the height of the COVID pandemic, when the world seemed to be collapsing around us and the stock markets went with it. So what it's showing you here is over a 1 year period from 1950 to 2022, the single worst year was a 39% loss if you'd been an investor in the US stock market. The single best year was a 47% positive return. So really wide variation. Now, bonds are deemed to be less risky, they're less volatile, and that's shown there with a narrower range of returns. Still significant losses, potential double-digit losses, and still high gains, but that range is much reduced. And as we expect, if we blend the two together and have half in stock markets and half in bonds, we get a mix of those two returns. Now, when we go out over time, what's really important to notice here is that range of return reduces, and they also become the lower returns become more and more positive, if that makes sense. In the 5 year rolling periods, we can still have some negative returns, much greatly reduced. But as we go out through time, all the way to 20-year periods, 20-year time frames. So if we're investing for 20 years, what it's showing you here is if you'd invest in the stock markets, your worst return for a 20-year period would be 6%, and your highest 17%. And you can read the various numbers for the bonds and the balanced portfolio too. So it's just showing you that if you can accept and are willing to be prepared to ride out the losses here, you get rewarded over time. And we can see that by looking at this table here. We can say that if you'd invested in a stock market portfolio, purely stock markets, for that 72-year period, your average annual return would have been 11%. Now, none of us are going to be obviously invested for that period of time, but it just shows you what the extra return we can get when we take more risk with our money. So I hope that helps explain it. I hope that you can see now why we accept the short-term losses for long-term gains, and why it makes sense to stay invested when the world is falling around us.